This is the show the Real Vision community has been asking for. 3 ideas. And exactly like the title suggests, an expert comes in and gives you 3 ideas about where you can put your money right now. It's not trading advice, but it is a starting point for you to do your own research. We're showing you a sneak peek, but click here to subscribe and get the rest.
The paradigm has shifted dramatically. And I think that people that are looking at the past 30 years for guidance on how to invest for the next 3 months, 6 months, 3 years, 10 years are looking in the wrong place. We launched the Inflation Beneficiaries Fund in early 2021 when CPI was still below 2. People thought we were crazy to be talking about higher inflation, but we'd actually been worried about it going back to call it 2015, 2016, where our chief investment officer, Murray Stahl, basically came up with a thesis where he said, look, valuations are high. The only reason that you can really look at is financial asset inflation. And money supply was growing around 6% a year. Interest rates were extremely low. It was a slow burn, but eventually there was going to be inflation. But the real differentiated view there is that we looked at things from a supply side as opposed to purely from a demand side. And we have a thesis that the prior 30 years were actually artificially low inflation, i.e. disinflation, because of an era of abundance. And that era of abundance really coincided with cheap labor and cheap materials, primarily from the East being shipped to the West. And so that really created disinflation in the West. But a confluence of factors, one of which being the pandemic and reshoring with supply chains, but also just rising GDP per capita, which is parlance for rising standard of living in these nations where we've had an abundance of commodities and labor for the past 30 years, is actually shifting to where now they're actually competing for the same commodities and labor as us. And so the paradigm has shifted dramatically. And I think that people that are looking at the past 30 years for guidance on how to invest for the next 3 months, 6 months, 3 years, 10 years are looking in the wrong place.
And you really look at higher structural inflation and walk us through what that means exactly.
Yeah, again, that's a really important point as well, where a lot of people misrepresent inflation because there's really 2 types of inflation. There's cyclical inflation and there's structural inflation. And you could argue that a lot of inflation in the past couple of years, or certainly the past 18 months, has been cyclical, related to a lot of money entering the system. The money supply in the US grew over 40% over an 18-month period, some of which was money literally being handed into the bank accounts of consumers. And so you saw things like used automobiles, microprocessors, home goods, things that people were doing renovations, things like that, where there's a cyclical mismatch between supply and demand. But lo and behold, we're going to make more cars. There's going to be more semiconductors. There's going to be plenty more refrigerators and countertops and washing machines. That's cyclical, and that can be impacted by demand, but also the supply is going to respond very aggressively. We're already seeing that. The other type of inflation, which is a lot more pernicious and a lot more important going forward, is structural. And what I mean by structural are things that are far less inelastic in their demand profile. So think about energy, food, raw materials that are requisite to our daily lives. And demand there is far less elastic, meaning that people are going to heat their homes, they're going to drive their cars, they're going to eat food. But the supply side takes a far longer time to really catch up to demand, where, okay, there's a couple short cycle energy wells in the shale patch, but most of that is 3-5 years. Copper ranges from 7 to 10 years. Food, you have a whole planting season, and it really depends if you have the infrastructure in place. And so that is the structural inflation that we think the paradigm has really shifted in, and where the market is really missing the forest for the trees.
And James, before we get to your 3 ideas, you have this nugget that really fascinates me. So if you could give investors just one piece of advice, what would it be?
I'd say one piece of advice that I would give to investors is to always seek out unique data or information. And what I mean by that is, it's easy to just look at what the headlines on Bloomberg or the Wall Street Journal are, or see what Morgan Stanley or Bank of America is saying about a company, but everybody sees that, everybody knows that. There's so much value to be unlocked looking at industry specific information. So, trade magazines or local newspapers, things like that, where you're just going to be getting unique information that can really formulate a unique opinion that's not just consensus. I'd say that's been invaluable in my career, and really highly recommend it.
So I want to jump into your first idea because it really plays off exactly what you're talking about here. And that first idea is Prairie Sky. Now, this is a Canadian listed company, one of the largest Canadian oil and gas royalty companies, emphasis on royalties. And if you can really walk us through the upstream, midstream, and low stream that you look so closely at, because that's really important here in terms of getting all those different royalties.
Yeah. And so just to be clear, there in the energy sector, most people are familiar with the upstream, which is companies that spend a tremendous amount of money to explore for and extract oil and gas. So you spend a lot of money exploring, and then you spend a lot of money drilling, and then obviously a lot of money getting that oil to market. So that brings up the second part of the supply chain, which is the midstream. Midstream are pipelines and gathering facilities and storage facilities that basically bring the gas to market. And then finally, downstream is the gas station or the retail distribution where it actually ends up with the end consumer or business. The problem with all three of these businesses is that they're incredibly capital intensive. So you spend a tremendous amount of money up front for what is typically a low return on assets. Meaning you spend a lot of money to make a little money. So the companies tend to use a lot of debt in order to enhance the returns on equity, and that's fine. But if you spend money at the wrong part of the cycle, or you're wrong, or there's a very pernicious down cycle, you tend to impair a lot of capital in these businesses. The reason why royalties are such a eloquent business model and not really properly appreciated in the market is that they remove a lot of that capital intensity, because a royalty in its purest form is purely a revenue interest in the production of another oil company. So again, go back to those upstream companies. In Canada, let's say Canadian Natural Resources or Suncor. In the US, you could compare those to Exxon and Chevron and Conoco. They might be spending hundreds of millions, if not billions of dollars extracting oil and gas. But you as a royalty holder have a cost-free revenue participation in that production. So what that means is the more they produce, the more revenue you make. The higher the price, the more revenue you make. So in a world of rising production and prices, all of this revenue flows through to you, generally cost-free. So because of that, royalties such as Prairie Sky can operate around 90% cash margins, and they need to reinvest very little capital. This is going to be absolutely critical as the commodity cycle matures, because at the beginning of the cycle, everybody's making huge amounts of money because costs haven't really filtered through the system. So again, going back to the Chevron or Canadian Natural example, they have a lot of upfront costs, whether it's labor, whether it's equipment, things like piping and frac crews and frac spreads and trucks and you name it. It's a very capital intensive industry. That cost inflation is just beginning to hit right now. And so that's actually going to hurt their margins. But then the longer effect on margins is going to be reinvestment. So if you were reinvesting capital at $40 oil, you're probably pretty happy right now. If you're trying to reinvest in a world of $90, $100, $120 crude, you're going to have much higher prices to pay. So that's why we think that the royalty business model is so advantaged and a really eloquent way to play what we think is going to be a secular rise in energy prices worldwide.
Hey there, revolutionaries. To join a community sharing insights like you just watched, head over to realvision.com. There you will get unbiased insights and exclusive access to the very best, brightest, and biggest names in finance. Be a part of our community of lifelong learners. See you there.